Okay, hi there. Jeff here with a country focus video. Lots of you will be revising development economics as part of your preparation for a synoptic paper. I thought I'd just say a few things about a really fascinating country, and that's Vietnam. So Vietnam is one of the fastest growing countries in the world, and its economy has shown quite a lot of resilience to things like trade wars and the COVID pandemic in recent times. It continued to grow in 2020 and remains one of the fastest growing nations in the world economy, and undergoing obviously a structural transformation in particular as labour shifts from farming towards manufacturing and services, and including things like tourism. So what are the key features relevant to the exam of Vietnam? Well, first of all, I think it's a great example of how a country can drive growth and development through trade. In fact, trade has been hugely important. Vietnam is now the second largest producer of coffee in the world after Brazil. Did you know that? So it has a significant comparative advantage there. And it's also, by the way, the world's largest exporter of fish and seafood. There's only China and Norway ahead of Vietnam these days. In fact, Vietnam is now a top 20 exporting country in the world. So a good example of trade. I'll say more about that in a few minutes. Also a good example of changing comparative advantage. So Vietnam is undergoing a structural transformation. Industrialization processes happening at pace. And also, of course, a move away from industry largely towards other services. Vietnam, I think, is a good example of some of the benefits and the risks of being a highly open economy. Trade as a share of GDP in Vietnam is over 200%, if you add together the value of exports and imports. They also have a managed floating currency, the Vietnamese dong. So that could be worth thinking about in terms of the debate about free floating versus managed floating exchange rates. We'll discuss the extent to which Vietnam has managed to overcome barriers to growth and development, and think about their strategy, which is really interesting. So Vietnam is a one-party state with a communist party in charge, but they are now following a mixed approach, if you like, almost like a socialist market-orientated approach, which is really interesting. I think Vietnam would be a great example to use of a country if you get a question on the importance of foreign direct investment, both the benefits and also the potential drawbacks. And we'll also say something about the challenges facing Vietnam in a global context. So this shows Vietnam's share in world GDP, adjusted for purchasing power parity. And you can see that from 2016 to 2022, the forecast there, their share of world GDP has increased from just under 0.7%, pardon me, to 0.8%. So it's not yet in that group of countries with at least 1% of the world economy, but it's getting there and no doubt will in the future. So over the last 30 years, Vietnam has sustained very high GDP growth rates. It's right up there in terms of the Premier League of growth countries. And essentially that's fast forwarded, it's accelerated a transformation of the economy into a lower middle income emerging economy. Now, Vietnam pursues export-orientated trade policies. Trade is seen as absolutely pivotal, crucial for their growth and development. And there's the data. Vietnam's ratio of trade to GDP, if you add together the value of exports and imports, trading goods and services, it's increased from 165% in 2013 to 210% in 2019. That was obviously the year before the pandemic. Vietnam operates a managed floating exchange rate. Hopefully you're on top of that. And you know what that means in terms of the central bank managing the direction and the pace of change of the currency. Now, crucially, Vietnam is a great example to use of a nation which has built a comparative and competitive advantage in manufacturing, particularly for textiles and also consumer electronics, particularly smartphones. What Vietnam typically does is it imports intermediate goods. So 85% of imported electronic products were intermediate goods. That's the components that go into, for example, a smartphone or an iPad or a TV screen. Nearly half of which was supplied by South Korea and China. 44% of exports are final consumer goods. So essentially Vietnam has built its advantage in assembling and manufacturing intermediate goods into final products and then exporting them. And half of which were shipped to the United States, the UAE and Austria, interestingly. Vietnam maintains a trade surplus, quite a big one, as well as in remittances. So Vietnam has huge ambitions, actually. The recent 13th National Party Congress set a target for Vietnam that it will establish itself as a developing country with modern industry and become upper middle income by 2030, only 8 years away, and a developed high income country by 2045. Ambitious targets. If you think about the structure of the economy, Vietnam has obviously largely state-owned industries, so things like textiles, food, plastics and paper, etc., and tourism and telecoms. Farming is about 15% of GDP, but employs about a third of the workforce. 15% of output, but one third of workers. Now that has clearly come down since 2013, but it does suggest something about the relative productivity of the farm sector compared to manufacturing. And their main farm products are rice, coffee and rubber. They're the second biggest exporter of coffee in the world. Now crucially, what Vietnam is trying to do is industrialise. So it's seeking to continue developing its manufacturing sector, and they're helped by having low unit labour costs, and the demographics favour Vietnam. They have a high supply of relatively skilled younger workers, which makes the country attractive to inward investment. In fact, they do have a very young population, approaching 100 million, but a median age of just 31. 2/3 of the population of working age, and they have a very high labour market participation rate. 77% people are active in the labour market of working age. So here's some data on Vietnam, just in terms of a little bit of stuff on development progress. They have a high development rating, but they're 117 out of 189 nations. GNI per capita, of course, you adjust for PPP here. If you measure in real terms at 2017 prices, make that purchasing power parity adjustment, there's been a significant rise in GNI per capita, although there remains a big gap between male and female, as you can see there. Extreme poverty, because of that rise in per capita income, extreme poverty has all been eliminated. And I mean, something like 1/5 of the population now have joined the sort of global middle class. Increase in life expectancy since 2010. There's been an increase of over half a year there. Expected years of schooling high, and mean years of schooling has gone up quite a bit as well, although there is still a gap. The Gini coefficient, 0.35. Look at some of the macro data. This is quite important. So real GDP per capita in dollar terms has gone up. The share of GDP from farming has come down from 20% to 15%. The share of GDP from manufacturing has gone up from 15 to 18%. So there's some evidence of that transformation in the economy since 2013. Unemployment in Vietnam is extremely low. Now, clearly there will be some hidden unemployment and some underemployment in the informal economy. But officially it's less than 2.5%, 2.2%. Productivity growth has been strong, averaging about 5%. Inflation, well, they've had some inflation problems in the past. Just before the pandemic, inflation was 2.8%. I think it's currently about 4%. The exchange rate, the Vietnamese dong against the US dollar, well, that's been depreciating in nominal terms. You can see there that in 2013, there were 20,000, effectively 21,000 Vietnamese dong to the dollar. They're now above north of 23,000. So currency depreciation, to what extent is that beneficial to a country such as Vietnam? They have relatively low government debt, although that has been increasing. And in terms of the savings gap and the Harrod-Domer model, their gross national savings is actually higher than their investment. So Vietnam is not short of savings. Indeed, they could finance their investment through those savings alone. They don't. They attract lots of FDI. But it suggests perhaps that there aren't that many domestic investments that are profitable to be financed. So it may well be the case that Vietnam has a surplus of savings. It's partly reflected in the current account balance, but of course, as an exporting nation, they are running a pretty tidy and persistent trade current account surplus. Really interesting. Export success allows Vietnam to run a big surplus. Now, Vietnam is transforming itself. Okay, they actually have a target to develop 20 products with strong international brands. So they're trying to diversify their economy and strengthen their position in the, if you like, the world supply chain. They're also trying to increase the localization of production. So at the moment, Vietnam's model is essentially import intermediate goods, component parts, assemble, manufacture, and then re-export. What they're trying to do is develop their own brands at manufacturing level, but also increase the localization of production so that when they're manufacturing an iPad, for example, or manufacturing an electric car, more of the production comes from local inputs. Trade patterns. Vietnam is simply one of the most open economies to trade in the whole of Asia. Indeed, in the context of your studies, one of the most open economies in the world. Don't forget, trade represents over 200% of GDP. These charts provide a little bit of a summary here. China and USA are Vietnam's largest trade and investment partners. And you can see what they're exporting here. There we go. The United States has 23% of export sales from Vietnam are to the States, 14% to China, then Japan, then South Korea. So taken together, we've got the 37 and 15, 52%. Over half of Vietnamese trade is with just 4 countries. Services. Many of you will be revising services as a source of growth and development. Vietnam's a good example for that. So travel and tourism is growing. And not just that, but Vietnamese nationals are also heading overseas. But Vietnam is also trying to develop its tourism sector. Massively important for Vietnam, if you're studying this, is the importance of inward FDI, foreign direct investment. So Vietnam joined the World Trade Organization in 2007, 15 years ago. And pretty much ever since, they have been the recipient of very large inflows of foreign direct investment. It now accounts for about 20% of GDP, 5 million people employed, and about half of Vietnamese exports are attributed to foreign investment. So let's be clear here. The Vietnamese model, pardon me, the Vietnamese model remains heavily dependent on foreign investment and exports. Attract the FDI and then export, especially to the USA and to China. Now, most of that FDI has been for manufacturing, although electricity and real estate also included. So some good examples. Let's pick out 2 or 3 examples for you. Lego is going to invest more than $1 billion in a new factory in Vietnam, I think in Ho Chi Minh City. And it's going to create up to 4,000 jobs, according to this report in the BBC News, as they scale up the factory. So lots of interesting economics here. Lego builds a factory in Vietnam. The benefits of FDI in terms of employment and output and exports. The multiplier effects possibly there. The extent to which Lego will bring some technology transfer. And also, crucially, the extent to which this project will actually employ Vietnamese workers. Samsung is building a huge factory in the northern province of one of the northern provinces of Vietnam. I think it's Thanh Nguyen, and it's going to be a huge manufacturing factory. Again, a good example of Vietnam attracting FDI there. And just recently, article in the FT saying that Apple is going to shift some iPad production to Vietnam, partly because of supply chain problems. So Vietnam benefiting from some, obviously, the Chinese economic disruption due to COVID, but also because Vietnam is now a low-cost manufacturing alternative to China. And then Apple can re-export out of Vietnam into other Asian economies. So in terms of trade relationships, Vietnam is a member of ASEAN Free Trade Area. They're important. It's also signed a whole clutch of free trade agreements with the likes of South Korea, the European Union. That one was signed in 2019, with Chile, with Hong Kong, with Cuba. and obviously strong bilateral trade relationships with the States. So again, I would use Vietnam as my example of where the country has really gone out of its way proactively to drive exports through free trade agreements. They are attractive to FDI. However, the Vietnamese government, then we get to state, one-party state, they do impose some caps on foreign share capital allowed in certain key sectors, and they're listed there. Things like private networks, telecoms, etc., road and rail. You are limited on the share capital that can be owned by foreign investors. A word or two about the exchange rate. So the Vietnamese dong is a managed floating currency, and here's the chart showing the dong against the dollar since 2012, so about 10 years. And you can see here that over time there has been quite a significant depreciation in the value of the dong. In other words, $1 buys more dong, or you have to give up more dong to buy a dollar. So there has been a depreciation of the dong, and some complaints that, particularly from the States, that Vietnam has been artificially keeping its currency low and managing its floating exchange rate in such a way to remain competitive, clearly as a big exporting nation. Now, in the summer of 2021, the United States reached a deal with Vietnam over this dispute about the currency. So there was a fear that this managed floating currency might precipitate a trade war. So under the deal announced in the summer 21, Vietnam said it will not manipulate its exchange rate in order to prevent effective balance of payments adjustment or to gain an unfair price advantage. So it's going to refrain from competitive devaluation of the dong. Interesting that those two countries come to that agreement. America's trade deficit in goods with Vietnam is the third largest of any country so far this year. So what's driving growth in Vietnam? A whole host of factors seem to be coming together to drive growth in Vietnam. The importance of FDI we've talked about. The net trade surplus, of course, is an injection of aggregate demand into the economy. Per capita incomes, reducing extreme poverty, drives consumer spending, and that in turn drives investment, especially when you have an emerging middle class of consumers who have money to spend and savings to save. The demographics favour Vietnam. They have a very young, fast-growing, young and relatively skilled population, and that's shown in increasing productivity. They're trying to diversify their economy, so growth through investment in travel and tourism, and the government making big investments in infrastructure to fast forward the process. And no country in the world has ever grown rich before it's urbanized. So you have to urbanize first, really, to really grow rich. And that must be the case in Vietnam. Urbanization rates are rising, and so you get those agglomeration economies in the cities. So some positives there for Vietnam. However, there are some barriers to development. And I think the key point I want to make is that the Vietnamese model, the Vietnamese economic and growth and development model remains really dependent, heavily dependent on foreign investment and exports. As we'll see in a minute, Vietnam is vulnerable to climate change, particularly as so much of the economy is coastal. They are very exposed to slowdowns in the world economy, so shocks in the USA or China, Japan and South Korea. They have a dual economy. So remember I said that 15% of output comes from farming, but it employs about 35% of people. So you have relatively low productivity farming, but high productivity manufacturing. So you have this kind of dual economy issue. And I think this point about FDI, FDI brings many benefits to countries like Vietnam. It lifts millions of people out of extreme poverty. There is a danger that you become a little bit over-dependent on FDI. And Vietnam has relatively few internationally known branded products of its own. And I guess going forward, that's what you'd expect them to try to do. Instead of just made in Vietnam, perhaps move towards branded or researched or designed in Vietnam. And I think the environmental challenges are really key. So the penultimate slide here looks at some of the environmental risks for particular commodities, from soil degradation, air pollution, water scarcity, deforestation and CO2 emissions. So there is a real danger that Vietnam's growth is unsustainable from an environmental point of view. A large part of their protective mangrove forests have been destroyed. Overfishing is clearly a threat to the common pool resource there. And Vietnam is undoubtedly one of the world's most vulnerable countries to climate change, particularly in the Mekong Delta. Farming uses 4/5 of available fresh water, so water scarcity becomes hugely important. Well, I'm not sure what exam question if they would ever set one on if they chose Vietnam, but I've just put 3 for you. Evaluate the micro and macro factors, which are likely to determine the rate of growth in Vietnam relative to other developing countries. Quite interesting. Evaluate the micro and macro barriers to development in Vietnam or a country of your choice. And evaluate the micro and macro policies which are likely to be most effective in achieving sustainable growth and development in Vietnam or a country of your choice. There we go. Thank you for staying with me. If you're with me at the end on this country profile video, hopefully it was useful and it might give you some context which could be handy in an exam paper. It's a really interesting country to study anyway, regardless of the exam. Stay positive, stay happy. See you soon.